how do they manage expectations? Because many feeling perhaps 44% pop, is that a little bit too much?
It seems like the sweet spot. If you think about the range, a typical IPO, you'd like to see 20 to 30%. This one was gonna have a bit more buzz baked in. If you look at Twitter, it was what, 70+% on day one. Facebook with the glitch was less than 1%. So somewhere in between seems like they kind of hit the sweet spot there. And when I look at trading and how the stock kind of flittered around that $25 mark all day, it was fairly stable. There wasn't a lot of swinging going on. We saw it sell off toward the end of the day there, down to its closing price of $24.48. But it seemed like a decent way to go out in your debut here. No one's quite complaining about the returns for investors.
I mean, looking at this IPO scoreboard, you look at Facebook, up now almost triple its initial IPO value, but after a year was down 31%. But Twitter, you mentioned it, on its debut opened up more than 73%, but look, after a year it was down 10%, now down 65%. So it's worth remembering that whatever happens on the first day of IPO doesn't always remain. Sarah, talk us through the managing of expectations, and indeed perhaps where the roadshow wasn't all smooth. There were some bumps they had to iron over, many questioning the user growth.
Absolutely. So this is a company that is trying as hard as it can to not set up those comparisons to the companies you just compared it to, Facebook and Twitter. This is a company that doesn't want to be judged on its user growth, but it's going to be judged on its user growth because that's a metric that slowed in the fourth quarter. And if you don't have the users, you can't make the money off the ads. But Snap's argument is that the user engagement on its app is just so immersive and so frequent that it kind of doesn't matter the quantity so much as the quality.
Yeah, we're 18 times being logged into the app, I think, a day. I mean, that's pretty amazing statistics. Alex, you and I were down on the New York Stock Exchange. It was a buzz, a frenzy. Goldman Sachs had their role cut out for them. They were being stabilization for the entire trade, and they took their time over it, didn't they?
They did. They did take their time, and that's kind of what they're known for. And what I can tell you now is that you saw Bobby and Evan ring the bell. We were both there for that. I disappeared a little bit, chasing them down, because they actually went over to Goldman to watch the first trade happen. So the execs had to get there. They had to kind of work through that. And the shares finally started trading at, what, 11.19? So you can see that gap between the 9:30 open there. And it was so important for them to find this sweet spot where they thought that the shares would trade at to get this nice pop. You saw them price at $17 a share, even though our sources say the deal was 10 times oversubscribed. So there is some kind of read-through that they maybe could have priced it a little higher. But if you think about the company's impetus for pricing it at 17 instead of making, let's say, $200 million more at $18 a share, doing that kind of rewards the shareholders who are willing to take a bet on them at the listing day and say, look, we'll give you a little bit extra wiggle room for your returns. And even though we're not taking so much money off the table, it's $200 million, so we can kind of ease our way through that in trading going forward.
Sarah, you're out there in Silicon Valley. The quick question, and so much hope was riding on the success of this particular IPO and how it trades in the next few days, weeks, months, years, is because there's plenty of other companies sat there waiting to enter the public market. How do you think it's been digested in Silicon Valley by the investor base and by other startups?
This was a very high-stakes IPO because, as you said, there are so many private companies that have ballooned in valuations into the billions, and in some cases tens of billions, like companies like Uber. And people have just been waiting for these companies to go public, but it hasn't been necessary because there's so much capital available to them on the private market. And also the markets were a little bit volatile. So they're looking at this Snap IPO. This is a big company, really the biggest social media IPO since Twitter. And they're saying, hey, if they can do it, that shows that there's an appetite on the market for these kinds of deals and maybe for highly valued stock.